Well, hello everyone, and welcome to the Boyer Brief. I'm Mark Boyer, and this is Jason Jacoby. Happy 2023 to you. It's been a couple months since we did a Boyer Brief. We did an outlook here at the end of the year, but we haven't been on the Boyer Briefs here recently, so we're glad to be back a part of that. So,
absolutely.
Wow, what an incredible year that this year started off as. I mean, it's been nutty, right? I mean, the markets have really moved here in January. One of the best Januaries in many, many years, a lot of market watchers say that speaks well for the rest of the year, but we'll see. We think it's going to be still pretty volatile. But you'll see here on the charts to the right, you'll see the Dow is up 2.5% year to date, S&P 8.8, NASDAQ up almost 17% year to date, which is just since January 1st. Russell 2000 up 13. So we've had a big move. We love this. We're excited about it. We're not surprised, but at the same time, we just caution all our clients to just, this is a long process, so it could get pretty volatile in here, especially as first and second quarter earnings start coming out.
Temper those expectations is basically
sure.
what I'm getting from what you're saying here. I mean, it's like you said, one of the best Januaries we've had in 20 years or something like that. It's been crazy, but tempering those expectations. I mean, expecting the NASDAQ to be up 16.8% this year. Could it be? Yes. Depends on a lot of policy, Fed policy, where we go with recession, things like that. But putting it in perspective, even though with the hot start we've had, that chart on the right there, Dow still down almost 4.5, S&P down almost 9, NASDAQ still down 15%, which is a bad year in itself.
Yeah, that's crazy, right?
And the Russell 2000 almost flat, but down 1.6%.
Yeah, so we had a low bottom, right, and then now we're bouncing off, so not unexpected again. But let's just keep our expectations muted, and we think we're having a solid year. But this trajectory won't last, throughout the year. So
this is not 2020, 2021.
Yeah.
All right, so U.S. Treasury yield. So I want to tell this story and then get your thoughts on this real quick, because this is really interesting. So this chart here, hopefully all you guys at home can see this. So I want to start back looking a year ago. So a year ago, our Fed funds rate was pretty much 0 to a quarter basis point, right? We're about like 0.25%. Interest rates were still down in the 1% for short-term maturities. Even I think the 10-year Treasury was hovering around 2% or something.
Yeah, that was very low. We had extremely historic low interest rates. Yeah.
So this is quite interesting. Why I want to mention this is because how quick the story and narrative can change. So looking back, that light blue line is the 3 months, so it's the shortest maturity, shortest duration. The black line, the 2-year Treasury, followed by the green line, which is the 5-year, to the 10-year, which is the orange. So starting the year, no yield curve inversion, everything seems normal. Though you do have the 5 and 10 that were hovering pretty close, and then you can see they kind of danced together throughout the year. But what's the biggest story, which kind of gives us a near-term kind of fear factor, I like to say, because 3-year Treasuries consider the risk-free rate of return pretty riskless in terms of on the investment scale, right? It's very short-term maturities, turns over quick, so tries to preserve capital when you buy something like that. That light blue line just shot up there. Now it's sitting at the highest, just meaning what? Like what does that insinuate when we have that be the highest in terms of
so yields? It's an inverted yield curve. I mean, so how you look at this is like if you're investing your money, 10 years out versus 3 months out, you obviously want a higher rate of interest if you're committing to 10 years.
Right.
But what's crazy right now is that's actually the opposite at the current time, right? So what that says is that the markets are telling us is that they believe inflation in the near term, basically over the next 6, 9, 12 months is going to be something we're fighting and continue to fight for. But longer term, the markets are basically telling us that they believe that inflation will not be a bigger issue. So they're not. So the longer term bonds are not right now giving us the interest rates to desire to be in them longer term, and they're not requiring a higher yield at the moment, which is really interesting. So you get these inverted yield curves. They're not 100% accurate, but they're very, very pretty close to being almost telltale that we're headed to some type of recession, or haven't, we'll talk about in a second, but haven't already been in one in some degree. So
that's great. Yeah, that's really good. So what are you telling your clients? I know with clients like ours, we get a lot of questions these days, especially with the high interest rates that you can get used to be the bank, what, 0.1, 0.2%, but now you can find a high yield savings account, or some banks are offering 4% above, which is kind of mirroring what we're seeing here. So what are you saying?
Yeah, I'm saying, what's exciting about the fixed income markets right now is that there actually some yield in the fixed income markets. We haven't had this for a long time. For many of us, going back to the 70s and 80s, we remember higher interest rates. You young people, you weren't even born. But life still goes on even in higher interest rate environments, and we can still prosper and do well. So what the beauty of the fixed income markets right now at all levels is that there is yield to them, and so we can we can actually count on them to provide a ballast against volatile stock markets and so forth, things like that they have been in typical 60-40 portfolio.
Yes.
Last year was a one-off year where volatility was together in tandem, both stocks and bonds, and we've not seen bonds react that negatively for over 43 years. So it's been a long time, and unexpected to some degree, but yet it's kind of been a reset on the interest rate. So that's a positive thing, and so we're real excited, especially now for older, for people who are invested, maybe older and not, wanting to preserve capital, but yet get good interest rates. We're in a much better place than we were a year ago, for sure.
Absolutely, love it. Good points. All right, so the last thing we want to talk about is what's on everybody's mind: recession, soft landing. How long is it going to last? I always tell clients these days, could be an inch deep and a mile wide, so it could be a little bit more prolonged. But at the same time, there's kind of some major factors that usually flash warning signs that haven't until more recently, right? So telling the story, if we can look at the top right-hand chart, which is right over here, want to look at job openings and hires and separation rates over dating back to 2019 here. So as you can see, things were kind of moving in tandem there for a lot of the time. Job openings, hires, and separations from employment kind of trended sideways. And obviously COVID hit, a lot of separations from employment, which happened immediately. The world came to a standstill, we all remember that. And then quickly, once things started to reopen, kind of figure out what this was, how we're going to proceed through this. Again, the separation from employment plummeted and have remained relatively low and kind of back in the trend line there. What hasn't remained in trend line though has been the job openings. So obviously we have a very tight labor market right now. Strong labor market, which obviously is the last bastion of strength of the U.S. economy, which is really interesting. So there's not enough people to fill the job openings right now. It's hard to find qualified people. Now, is that starting to change? I think it possibly is, right? That's kind of the trend we're starting to see.
Yeah, I mean, a little bit, but not a lot. I mean, there's just a lot of people that are still out of the, are still, unfortunately, a lot of young men who are still at home, playing video games. I mean, I don't mean that. I mean, I'm just saying it's just a reality. They got out of the market, the jobs, and they basically haven't come back yet. So the economy wants to go, and so what's interesting is that Powell and others are watching these numbers, and it's real important for them in the interest rate piece. But it's very seldom that because we believe we're into a recession, but then the job markets are still really tight. And again, there's availability. I see, we talked about this a couple months ago. I mean, we see for hire signs everywhere. Yeah. And I have good friends and even family members who are running companies that are having a hard time finding good workers. So that's a challenge, but a lot of it's separation. You see that people have basically kind of exited the job market. So we'll see how that plays out. At the same time, you see, and that's part of this recession is that we're trying to balance the jobs with the current economy. So the Fed's looking at, wow, the job market's really tight. So that means wages are going to be tight and higher, and they're trying to raise interest rates to bring all this down. But at the same time, we are seeing, especially in the bottom left there, that graph showing like the job, the firing, or layoffs, and you see that technology in mostly probably late 22, late 22, and even recently, you're hearing of big technology companies laying off people. So that's definitely, those higher interest rates are driving companies, the big tech companies and others to start to really lay people off. So, and we've been talking about bad news is good news for the markets.
Yeah.
And so I think that's part of what the Fed's watching and why the markets even now are rallying, because some of that starting to slow down.
So let's talk interest rates. Obviously, our consensus and what we're thinking, in our opinion at least, possibly one more 25 basis point rate hike here, pause through the end of the year. I personally don't think that we're going to see rate cuts before the end of the year, because it's going to take a while for this all to bake into the economy that we've talked about.
Yeah.
And we don't want to kind of reverse the switch too soon, where inflation ramps up again because they start cutting rates and the economy just kind of spirals again. We don't want that to happen.
Correct.
Obviously, we hold from an economic standpoint a different mindset of, hey, maybe we think about deregulation, open the supply side so we don't have to destroy the labor market.
Great.
But with the trend that's happening now, we're seeing that not take place.
No,
and so,
and it's not going to.
So would you have that consensus as well? I mean, 25 basis points possibly in March, and then we'll see kind of thereafter?
Yeah, I think we'll, we got that yesterday. We'll expect another 25 basis points. The market is expecting mid-year for cuts. We don't think that's going to happen. So again, that, probably not till late this year or even into next year before they actually start pulling things back. We got some more time here, so we'll see how the markets react to that as we move forward here. But yeah, no, I think you're spot on. I mean, the goal here is to try to see a soft landing. Hopefully, the Federal Reserve will do a good job of watching that closely. Those job number, all those things, and take into account that it's a lagging indicator, and so they don't keep raising rates, and the market is counting on that. And basically what Powell said yesterday was very comforting to the market, and that's why we're getting kind of this run, because the markets believe that they're going to slow it down.
Good points.
Yeah.
Good points. So let's talk soft landing. That's one of the key words that we've hearing a lot on the news. You just said it as well. So soft landing, you're hearing different definitions of it, because I've heard on TV, on Fox Business or wherever, they talk about soft landing. That's considering a mild recession. It would be considered a soft landing. So it doesn't destroy the economy. It slows it enough where things contract, GDP numbers contract, labor force weakens a little bit, brings wages down in terms of just being able to find qualified workers and not having to pay such a premium to do so. You're seeing different definitions of that. So we've always talked about here, we always thought we were in a recession last year. We had, obviously, the bottom right chart, two quarters of negative GDP growth, right? We've had economic contraction in terms of GDP numbers, which we would consider, hey, that's a recession, right? And now we're talking recession again. So how can we have both? Is there a way that could be true on both ends of this?
Well, so if you remember, the traditional description was 2 negative quarters of lowering, negative GDP as a recession.
Yep.
But then for some reason, for lots of explanations to it, is that basically they changed the definition when it happened.
Yep.
And everybody said we're not in a recession, we're not in a recession. So, and the argument is that the job market was too strong to actually consider it a recession. So, personally, I mean, I looked at it as like we did enter a slight recession because we had those 2 quarters, and we're probably we've had an had a little bit of growth here the last couple of quarters, and then we see it going back, going negative again to a slight recession again. And we've talked about this, you and I, is just maybe we're in a rolling kind of recession where we get some ups and downs in here that I don't know how long that would last, but that's very possible. So just as again, COVID and all this stuff that happened the last few years, is really, it's a different type of an economy. And trying to figure it out, it's a little different. So I agree with some economists that I've heard is like it could be more of a rolling type, recessionary situation here. But we're definitely hoping for a softer one and not a deep recession.
Right.
And that's where we're afraid, if they raise interest rates too aggressively, it will cause a really deep one.
Exactly.
We're at the end of if you look at an economic cycle, all economic cycle, capitalism, they go up and down. We're on the back end of an expansion. We're coming down, into hopefully a recession. Okay, because, and why I say hopefully, because if we don't have some pullback and then it doesn't, those recessions set us up for the next expansion. So we actually are hoping for a softer drop, and then it sets us up for a new recovery. Okay, so that's exactly where we're at in the cycle. Some of the European nations are probably a little bit ahead of us in that. You're seeing some moves actually in positive for the international areas, but that's kind of how we're looking. We've showed that chart before, but yeah. So, and we expect that to kind of lower in, and the markets will anticipate the recession coming out of that ahead of time, which it's trying to do now.
6 months.
Yeah. So anyway, we'll see how this year goes. It's going to be very interesting and fun. We don't expect what we saw last year as far as the big drop, but again, you never know what's going to happen. We manage it as it comes.
Absolutely, those are good points. So, any last thoughts before we say and bid adieu for this month? We got some exciting news here that we're starting.
Got some fun news going and some new things that we're doing here. But I would just say, again, I think I say this every time. Have a plan and stick with it. Make the adjustments you need to. And as long as you can sleep at night with the volatility that's going on, and last year was a big test for that, it's important for you to stay the course. Because our biggest enemy in investing, frankly, is always ourselves.
Yep.
It's our own emotions, and we hurt ourselves more than the markets do typically. So if we can stick to our plans and go, and I mean by that is we get very emotional and we make the wrong decisions at the wrong time. So let us worry about that, clients, people. So that's our job. But stay the course, and we're looking for a solid year this year. Some in many aspects. So
absolutely. Well, that's it for this month's Boyer Brief. But like I was saying before, we have some really exciting news. Mark and I are going to be hosting a podcast in studio here at the office called Move the Chains, obviously owed to our football backgrounds. Really excited about that. Going to have industry titans, investment professionals, different leaders from different sectors of the economy. Just awesome people. We got a few lined up already. We're excited to have that. We'll be posting those things on our website, starting on a monthly basis, but maybe going to more bi-weekly or weekly basis once we get a little library going. But time is precious, so we'll see. But be on the lookout for that. And for this month's Boyer Brief, I'm Jason Jacoby, Mark Boyer.